China's financial crisis explains Sun. Whenever a financial crisis emerges, the Chinese Communist Party habitually holds up the roughly 14% capital adequacy ratio of China's banking system as a shield. Regulators and state media claim that Chinese banks are well capitalized, risks are under control, and capital adequacy ranks among the world's best. This narrative is a deception aimed at Chinese society and a misdirection for international observers. In China, the capital adequacy ratio has long degenerated into the emperor's new clothes. If bank capital were truly sufficient, why would emergency transfusions be needed? The most direct counter-evidence is that in the first half of this year, the CCP urgently issued special treasury bonds to inject about 500 billion yuan into the banking system, officially described as shoring up the capital base. Does a genuinely well-capitalized system require fiscal blood transfusions? Emergency capital injections mean banks are genuinely alarmed. This is not forward-looking planning, but crisis patchwork. The narrative of capital adequacy thus collapses under its own weight. The capital adequacy ratio equals capital to risk-weighted assets. In China, however, massive risk assets are excluded from the denominator, leaving true exposure grossly understated. First, real estate risk has been systematically ignored. In 2023, China's real estate market was worth about 450 trillion yuan, over 70% financed by bank credit. Housing prices have since fallen 35 to 40%, pushing vast collateral below loan principal, yet these loans remain recorded as performing. Second, bad debts of local government financing vehicles are persistently overlooked. With liabilities of at least 200 trillion yuan, cash flows have collapsed and debt rollover has become the norm, while risk weights are artificially suppressed. Third, policy banks and quasi-policy lending total at least 100 to 150 trillion yuan. Repayment capacity is secondary to political objectives. In substance, these are fiscal expenditures disguised as bank assets. The static picture is alarming. The dynamic trajectory is the real black hole. Real estate continues to fall, local finances keep bleeding, new loan quality deteriorates, and non-performing loans keep rising. Yet the response is delay, postponing recognition, adjusting statistical definitions, rolling over debt, and substituting narrative for reform. When real risks are excluded, when bad debts are handled politically, and when fiscal transfusions are labeled prudent, capital adequacy ceases to be a safety indicator. It becomes a numerical fig leaf. Officials shout 14%, world-leading, while being forced into emergency recapitalization. This contradiction alone shows the system has entered a danger zone. Tearing away the curtain of lies is not alarmism, it is the only starting point for genuine recovery.